You know that feeling when you open your phone up, you click your stock portfolio, and you look over things, and everything's red? Not fun. And from there, you have three options. You can panic sell, you can panic buy, thinking there's an opportunity, or you just do nothing at all, which sometimes is the best thing you can possibly do. So today, I'm going to take you through the three steps that I go through whenever I see a big red day in the market. And this is something that you can go back to whenever there is a really bad day and trust that this system will make it so you're making the best logical decision. And often that will likely lead you to just doing nothing at all. So, to start off, here are some of the most common mistakes that I see when people approach a red day. The first is just blindly buying the dips. And this is never a good plan because there could be something really serious going on in the market that you definitely do not want to start buying into. The next would be panic selling. And to me, this is the worst thing you can do. You let emotions take over, and a big winner that you've had in your portfolio, you might let go on just a single down day when it's been great to you over a really long time. And then finally, another big thing that I see is just listening to social media and trying to buy a stock that you know nothing about. It's so important to really be informed on the companies that you're purchasing because if not, you're just going in blind. So the worst one out of all of these is easily panic selling because again, we really want to focus on the long term when we're thinking about stocks and not let these really bad days get in our way. Now, before I do anything on a red day, I want to find out what kind of bad market day is this. So, some examples of what can cause a down day in the market. You can look for, were there any big news around inflation or interest rates changing? Did a very big company just report earnings like an Nvidia or a Microsoft? Was there anything seasonality going on where people rotating away from tech and into another sector? Or is it really isolated to just one company and other companies are down because of something another company did? All of this context is really important to keep in mind because whatever kind of event caused this down day affects what you should do as an investor. So, with that in mind, here is my first rule when it comes to down days in the market, and that is I never buy the first dip. And this might seem counterintuitive to a lot of people because when you jump on your phone and you check the stocks and see that they're down, if you know that you can make money and see this as an opportunity, your instinct will be, oh, there's a fire sale going on. But it might not be the right time to buy. And the reason why it's not the time to buy is there's generally a very big influx of people who think exactly like this. You have a lot of people that are going to buy that first dip. And as the dip continues to get lower, there is usually a bounce that comes off of this. And this is more of a pump fake if it's actually a down market. And after this happens, you're going to see a temporary recovery up, and then the slide will continue from there. So I want to buy after the recovery is up and let the market settle in before I react to anything. This is where sticking to the plan and sticking to this first rule is critical so that you don't make this mistake like most investors out there are guaranteed to make. My second big rule to follow is that red days expose the truth around companies. And what I mean by this is I separate the truly great companies from the companies that have been writing stories and hype. And what you will notice is the companies that are truly great will sell off right along with the rest of the market. And this is where the opportunity comes about. But then those other story stocks, like I mentioned, that have been riding hype, they are the ones that crater and pull back extremely quickly. And this is because the people that are holding those stocks, they don't believe in these companies for the long term. They may have heard about them on social media, or they just have been jumping in and riding the hype train. This is why they're willing to let those stocks go immediately as soon as things get shaky from there. Those big companies, the ones that have truly great things going for them, those are the stocks that people buy on the dip and hold. And you will notice this, that if you wait too long on those great opportunities, those companies bounce back to their pre-dip levels extremely quickly. And I keep these companies in mind when I'm viewing across things, and it helps me remember what stocks were really riding the hype and which ones were really a good company to start with. If you jump in on these story stocks after you've seen them really dip, stocks are fun until they aren't. And these things will teach you really valuable lessons, so just don't do it. Avoid these crazy hype stocks when they pull back like this. Third and final rule to always follow is to never go all in on your cash on the dip on that red day. You want to be able to buy just a little bit when you do decide to buy. And the reason this is the case is because you never actually know if the time you're buying is the end of the dip. And a lot of the time, it will not be the end of the dip. So you'll be really happy you did not go all in because you'll be able to buy it at a lower level in the future. Now, there's always opportunities that fall by, and you will look back and be like, man, I really should have went all in and bought at that one time. And that's the kind of regret that you can move on with, because if you did buy a little bit, the stock price would have gone up and you would have benefited anyways. So it's really good to not look in the past and regret not going in, because that was the right safe move at the moment. And don't worry, no matter how good the company is that you bought, it will drop again and there will be another opportunity. Trust me on this. So those are the three rules that I always stick to and help me stay stable and logical during those crazy down days. And this kind of advice I totally get is way easier for me to give to you than it is to actually deal with in the moment. But the key thing is, the more you invest, the longer you do this, the more experience you get, the easier that these red days are to deal with. And you will realize that some of the best days in the market follow the deepest declines in the market, and staying invested for the long term is the best way to not get bothered by these down days in the market. So the goal on these down days is not to just buy everything and try to beat the market. It's totally okay to just sit there and do nothing and just learn from the down day. We all have to go through it, and it's all part of investing. If you learned something from this video, please give it a like and be sure to subscribe if you like more of these real-world investing tips without any hype behind it. Also, I'd love to hear in the comments, how do you like to deal with down days in the market? Do you have a success story or maybe a bad event that happened? I'd love to hear about both. Really appreciate you watching. We'll see you in the next video.